Something has just happened. I don't know what. Something has just happened. Something has just happened. Horrible. Does anybody know? Something has just happened. Something has just happened. Does anyone know? Something just happened. We need to find out what it was. Something just happened. Good morning, Dr. JB. Good morning, and Cozy. Something just happened. I don't see any news. But the market is experiencing a crash right now. A crash. The market has just dropped $4 in 1 minute. Something is definitely going on. Does anybody know? Does anybody know what has happened? I'm trying to find some news right now. Still trying to find out what happened. Market just experienced a almost like a flash crash. It just took place. Ordinary peeps. Dr. JB, do you know what happened? Okay, we'll go with that view. Yeah, that was crazy. That was bananas. This is the trend. This is trend. it does coming down to my area of interest, the 679.8 area. Looking at a 681 put, getting into 679 and below, taking it to 677, possibly 676. She drops here, 679, comes back below 679. Where I want to get to. Now she's red for the week. 678. Now she's red for the week. 678. 677. 3. Still putting my plans together. How much? Let's see real quick. If anybody has any plans they would like to share, please feel free. Put them in the chat. $10. Yeah, I like those. That's gonna be my plan, to get in a put below the 679. I'm really thinking 678.7, because then the bulls will lose the week there. That's gonna be stronger. That's gonna be safer. $678.7. Area for me to take a position in this going to the downside. Yeah, that's it right there. If anybody else have any plans, please feel free to put them in the chat. Let me show you what it looks like on TradingView. On my TradingView algo, I'm interested in a put below that 677. Like I said, that 678 area, that's what I really like, especially now since I see that it's lined up on my TradingView. So yeah, I'm really going with that, 678.7. From there, I believe I can get into a position, not just a trade, but a position to the downside. Shout out to the team. Quiet Soul just checked in. I still don't know what happened. Does anybody know what happened? What caused this temporary drop so abruptly? Let me see if I can find out real quick. Oh, okay. I heard the Fed just gave big banks quite a bit of money. I don't know. See if I don't know. I'm not picking up anything. Let's see here. Payroll at U.S. companies fall by most since. Okay. Yeah, a lot of bad news just dropped. Payrolls at U.S. companies, they fall by most since 2023. That was some bad news. Stock futures turned lower as ADP shows surprise jobs decline. That was bad news. Private employers unexpectedly shed jobs in November. That was bad news. So the market got hit with back to back to back bad news, which caused this drop from 683 all the way down to 680 in 10 minutes prior to market open. So we want to be very careful this morning. Yes, Ordinary Peeps said the same thing. ADP report. Thank you, sir. Thank you for that. So we definitely want to be extremely careful this morning. We want to be extremely cautious this morning. This is, however, the area on the chart where I do like to get in a position potentially for a put. We will see how the morning goes. I will still follow my rules to give this market some time to really let us see, what is it going to do here. And again, of course, we're looking for setups for our entries. Big Ben is in the building. Microsoft lowered AI software sales, Nkosi said. Wow. Thank you, team. So to retrace, it really dropped. Yes, it really did. Really hard. Well, the question is it sustainable? Will the buy the dip crew show up, or could this be the beginning of something else? It's going to be a very interesting day today. We do have right now currently a controlled buying algo. We know what can happen with that. Let me go ahead and identify that. There that algo is right there. Got it up on the screen for you. It's a control buying algo. Where do we go from here? Bismillah, as we begin today. Like this put. Perhaps. What's the market saying? Take it easy. Take it easy. See what the market's gonna do. Slight hesitation. Slight hesitation. Very volatile right now. Excuse me, team. Very volatile right now. Regardless of what happens, we're still going to be able to find profits in the charts. All we have to do is take our time, follow our rules, and remember, it is our rules that makes us money. So if you do take a trade, make sure you take a trade based upon a set of rules, please. Is Microsoft responsible for the drop alone? I do not know, Ben. I actually wish I knew the answer to that question, but I don't, buddy. But I still like my my process of allowing the chart to develop and then picking only the best, leaving the rest. There's a lot going on this morning. And also, times like this, we should be referring to the higher time frames. Yeah, I see what you see. Big Ben just said so many other stocks are going red. Netflix is red. Nvidia is red. Meta's red. Very interesting. Need to give me a cup of. I was thinking it was a confluence of everything mentioned in the room. And Kosi said, and I think you might be right in Kosi. It might be a little bit of this and a little bit of that. But let me also pull up this other news too. Yeah, let me get me out the way so y'all can see this. Stocks fall as Wall Street weighs job loss data. Microsoft drops. Dow futures fall. However, Bitcoin is rising. Bond yields fall on Fed bets. Okay, stock erase gains. So again, it's not the news. But it's still important for us to know that there is news. It's all about the reaction to the news. How is the market going to trade? What is big money going to do? Where can we look for a position, not just a trade? Shout out Sai. Sai helped me look at things. I was watching a video he put out. He said you should start looking at things as more so getting in a position and not just a trade. Now, if you're catching a scalp, that's a trade. Okay, but if you are able to catch the trend, that's a position. Shout out Sai for that. I always like to give credit where credit is due. I wish Dollar Bill would come back to the channel so he could teach me how to trade gold. I might have to go on his Discord and ask him. Shout out to Dollar Bill. Congratulations to him for his Discord that's doing very well. But I'm hearing some people making money with gold. No, I'm not a flip-flopper. I like to stick with one focus. Focus on one course until successful. That's what the word focus means to me. F-O-C-U-S, focus on one course until successful. But I definitely would still like to know how to trade gold. I actually kind of, true story. Well, I mean, I don't have to say that because you know, guys, I'm completely transparent. But I had some physical gold, and I got rid of it right before it cracked 3,000. Yeah. So I've been so embarrassed about that. I haven't even commented on gold. Yeah, I know. I had the physical gold bars. Shout out Timepiece Watches. Timepiece Watches out of Miami. Not only do they sell some of the finest watches available, high-end watches, but they're also excellent gold, real gold dealers. So if you ever want to get yourself some hands on some real physical gold, let me know and I got to connect. I can put you up. Big Ben said, SPY is a high contact sport. Yes, it is. Yes, it is. Never stop analyzing. Because right now, it's getting a little bit heavy. The candles are getting smaller. The body candles sizes are getting smaller. The first opening 5-minute candle was a doji. The second candle Bear stepped in, has a wick on it already with only 20 seconds left on it. We're in this controlled buying algo that has the ability and possibility to come on down. Again, this is my area of interest where I would like to take a trade. I just hope, well, I don't want to say hope because we don't use 4-letter words on here. There's no hope in trading. It's only planning and executing. If the market does come down to my area of interest at 678, then I will take a trade. It's just that simple. Till then, I will be patient. Let me go ahead and set my alarm. 679.8 is where I set my first alarm at. And my original call was at the 683.4, and that's where it still will be. Going to be very interesting though, either way this morning. We are at yesterday's low according to the 15-minute chart. I'm sorry, I did not mean to say yesterday's low. I'm sorry, that was incorrect. I meant to say yesterday's close. We are at yesterday's close. Brooke Sanchez is in the building. Going to be very interesting to see what we do in this area of yesterday's close. You can see that here on the 15-minute chart on the left. And you can see it right here on the 30-minute chart, right here in the middle. Let me go ahead and enlarge it a little bit. There we go. Just a little bit easier to see. Referring right here, but we just hit yesterday's close. And it seems that the bears stepped back in again and are putting another wick yet again on another candle body. These wicks are bears rejecting higher prices. This is working out lovely in this flag. Would not be surprised if we had a nice red to green move. Market has my attention, but not my money. I'm gonna go ahead and reset my alarm as well. Bad news just keep coming out. Private employers cut jobs in November. Latest sign of a slowdown. But again, it's never the news. It's only the reaction to the news that we're concerned about. And once again, let me show you to keep a little bit of calm on my trading view chart. I'm interested in a put here, interested in a call here. Other than that, to me, this is a box. And I'm trying to stay out of the box. I don't need to be in the box. What color can I put the box? Yeah, it's a box. We'll leave it like that. This color. Yeah, it's in a box. So until we break out of it to the upside or break down to the downside, I'm not going to mess with any of this. This is how I see it. Time and patience now is all that's required.
I think place them is okay. I prefer and I expect that the IEEPA tariffs will stay.
I mean, I do wonder if businesses are hedging. I'm sure you noted that Costco became the largest and most high-profile company to sue the administration to get in line for tariff refunds if the Supreme Court doesn't go your way. What's your reaction to that?
Well, look, it's someone getting in line saying, if, I'd like some money. I get it, but it's not going to happen. I am confident it's not going to happen, and we will have tariffs no matter what going forward.
What about Taiwan? I know you've been in the middle of negotiating this one too, and we're watching, of course, it's important with chips, and not all the chip makers pay the tariffs, of course, because they're building plants here, but there is talk about them training U.S. workers to build advanced semiconductors as part of the trade deal. Is that true? And where are you on this?
Well, I'm not going to discuss where we are with the Taiwan deal because we're in the midst of discussions. But the fact is, this administration's goal is to bring semiconductor manufacturing to America, right? When we walked in the door, all there was the CHIPS Act, and that really was just a disaster. It wasn't working. So we reshuffled the deck. We changed the way we did anything. You remember TSMC announced a $100 billion increase in their build in Arizona, up to $165 billion. Micron invested more. Texas Instruments invested more. So we're up to like $300 billion in investment in America. I think when we do a deal with Taiwan, that's even going to be bigger. And of course, they're going to train American workers. The whole objective is to bring the supply chains to America, build semiconductors in America, build pharmaceuticals in America, train Americans to do it, and let's have that supply chain right here in America. That's the entire objective.
Piece on Politico this morning, Mr. Secretary, about a potential maybe executive order next year regarding robotics. Can you give viewers a sense as to how far down the runway you're looking on AI?
Well, I think, look, robotics and edge computing, which you think about it is, you've all seen like a modern auto plant, right? When you think about robotics, it's really the arms that do the welding and the arms that do the screwing and those kind of things, like you have in auto plants. This is why America can reshore advanced manufacturing, right? We don't have millions and millions of people to work and do little screwing in things, but we can bring advanced manufacturing here and have 3,000 and 5,000 Americans, doing the technician, doing the air conditioning systems. These are high-tech, incredible technical jobs that pay incredibly well. We're going to train Americans to do this. This is the workforce that's coming, and I think robotics, drone manufacturing, chip manufacturing, pharmaceutical manufacturing, these are going to be the linchpin of American advanced manufacturing going forward.
Yeah, we keep having this conversation with you at this desk. This notion of reshoring manufacturing, driving employment, but also driving automation. Where's the balance? How many workers can legitimately repair or maintain these machines? You understand that tension, right?
I do. Look, a semiconductor plant is a $20 billion automated plant, right? It's a clean room. But there's 4,000 people per $20 billion plant, and they're building 10 of them, TSMC, right? So that's a 30 to 40,000 person jobs. And these are great jobs, but they're technical jobs, right? They're fixing robotics. They're working on air conditioning systems because the room has to be cold and it has to be pristine, right? I met a pipe fitter, and I said, how is it? He goes, this is the greatest game of Tetris ever. I mean, you have to get the pipes in perfect location, in perfect position. And the guy said, this is the greatest job ever that you could ever have. And so the people love their jobs, and these are great American jobs. And we have to train 5 million Americans for these jobs because Donald Trump has brought the investment of $18 trillion. Now we have to train the workforce to do it.
Speaking of advanced manufacturing, Xlight, this is Pat Gelsinger's next act. It's the latest investment from the U.S., from the administration, from the U.S. government, $150 million. How do these come across your desk, Secretary Lutnick? Because I'm sure there are a lot of startups that are working on game-changing technologies that would like the investment of the U.S. government. So how do you pick the winners here?
Well, the CHIPS Act set a structure of of some money to go for advanced manufacturing of semiconductors and some for R&D. And the Biden administration had literally sent out $7.4 billion into some fraudulent company called Natcast, and it was trying to steal the money. We recaptured all the money, and now we can use that money to invest in companies that will advance manufacturing in America. So Xlight, as an example, is trying to augment the way semiconductors are made, right, and move to the next level. Right now it's called extreme ultraviolet. That's how you paint sort of the chips, the electronic chips, right? Silicon comes in, and then they paint it with extreme ultraviolet light, and that's how you create a chip that goes in your iPhone or an AI chip. So the Xlight is trying to design the next generation of it and do it with other technologies, and we are always open for that, but we do lots of diligence, we have lots of experts, and we sort of help, if it's going to help America and companies are backing it and behind it, then we're interested in being involved, because we need to make sure America stays at the forefront of technology and chip production.
Yeah, I mean, I know you mentioned at the cabinet meeting yesterday that how much we're up on the Intel investment, which is something that we have covered, and that's good for American taxpayers. But what's the exit strategy with some of these investments, public or private?
Well, generally speaking, the government just wants to make sure they're a winner. They've got the tools necessary. Remember, this is for chip production, right? You know, you have the greatest companies in the world, like Google with their TPU and NVIDIA with their GPU. We're not giving money to those companies. Those are design companies. We're talking about manufacturing in America. We're interested in manufacturing in America, and we're interested in the next generation of power in America, fusion technology, fission technology, right? Nuclear technology. These are the places where we want to make sure America's got the power here. And the exit will be simple. If these companies are successful, they'll go public, or they'll have a round and we'll exit. The exit isn't going to be easy if they're successful. And because we see everything, we can be very choosy. And the American taxpayers, remember, this money was already allocated. We're just doing so much of a better job. When we put out money, we get equity that pays America back. We don't love giving out grants. We love giving out money to companies and getting repaid for the American taxpayer. That's what happens when you put a businessman in the Oval Office. He understands fair balance and making sure the American taxpayer gets the benefit of the bargain.
All right, well, speaking of the market, before we let you go, I always have to ask you for an update on Fannie and Freddie. So when can we expect that IPO? Is it something you can get done by first quarter? Because I think last time you were on a few months ago, you said that it was a sooner rather than later story.
It is a sooner rather than later story. I think that's exactly right. I mean, I would like to see that, but this is a full administration discussing it, working it through. But we are well down the road on getting a deal done with Fannie and Freddie, and I am excited about its prospects going forward. I think these are great American companies that produce great cash flow, but the key is we want to keep the mortgage rates low for America. The fundamental first driver is let's keep mortgage rates as low as possible. We've got a lot of ideas in the offing, and that's bringing them all together to drive mortgage rates down. Remember, you've got first-time mortgage buyers because of the Biden inflation, 40 years old. That is just broken. When Donald Trump left office, they were 33 years old, the average home buyer. And then because of Biden's inflation, it went up to 40. Donald Trump is on it, and we're going to focus on that kind of opportunity together with the agencies going public. I think we're going to do some amazing things next year.
Q1? Is it a Q1 story?
I'll leave that to the announcement later.
By the way, one way to get mortgage rates, or at least the president thinks to lower, is the Fed. And are you involved in this process of choosing the next Fed chair? Did he ask your opinion?
Of course, he asked my opinion, but he has a really good list. He's narrowed that down really, really, really small, and I think he's got great choices. And I'm excited for the change because Jerome Powell is just political. He's just political, and it's ridiculous, right? Rates should be lower in America. We all know it. They should be lower, and it will make America better to have lower interest rates.
What did you tell him when he asked your advice? Who did you recommend?
he had great names. I know all the people that he was looking for. I had spent time with them all, and I had and I told him what I thought. But that's between me and the president.
All right, fair. You know I had to ask. Secretary Howard Lutnick, thank you very much for talking us through a lot on your portfolio, from trade to investments to housing. That is the Commerce Secretary of the United States.
When we come back this morning, a potential canary in the coal mine for the AI trade. We'll talk about this report about demand sending Microsoft shares lower this morning.
Plus, Krishna Guha from Evercore will be with us to talk about today's big miss on ADP jobs.
And Fanatics CEO Michael Rubin making news with us in Las Vegas a couple weeks ago. Remember this on CNBC? What about the predictions markets? Very hot right now, fast growing. Do you think that there's a risk that they cannibalize sports betting?
Yeah, so first, are you
going to get in?
I'll give this to you first, right here.
Yeah.
Let's go. I'm giving it to you right now.
Go. We gotta make
We're launching the next couple weeks.
Launching a
Fanatics prediction markets.
market.
Absolutely.
Is this with Crypto.com, as rumored?
It is. It is with Crypto.com.
All right, we will talk to the CEO of Fanatics Betting and Gaming about this entry into the prediction markets. Squawk on the Street. We'll be right back.
Welcome back. Microsoft shares under pressure in early trading near the bottom of the S&P 500 and holding back the NASDAQ after a bearish report around the company's AI software sales. Steve Kovacs here with the details. Hi, Steve.
There, Mike. Yeah, there's some nuance here, so let me explain what's going on. So the information reporting that Microsoft cut sales quotas by about half for this one specific AI product called Foundry. Now, that's a tool businesses can buy from Microsoft so they can kind of build their own artificial intelligence agents and then deploy them across their network. This is saying customers have found that it just doesn't work as right. They can't really get a good return on their investment and so on. So that is why you're seeing the pressure under here. But I would also point out, and this is also pointed out in the piece, and we've heard this from Microsoft just about every earnings report, while the consumer-facing part of AI isn't really growing like gangbusters over at Microsoft, it's the cloud side that they're seeing the real benefit from. That's in large part due to their relationship with OpenAI, which spends billions and billions and billions on Azure for cloud compute. You can see the growth rate right here. You might remember during the pandemic, that growth rate really decelerated and it started accelerating again after this AI moment and all that in capital investments on data centers and the like. But this report also hits something that I've been reporting on for like the last 18 months or so. I talked to CTOs, Microsoft customers, all of these people, and the story they keep coming back at me with is it's just better to kind of build your own AI tools yourself as opposed to use these so-called off-the-shelf products from Microsoft and others. Now, this report isn't talking about Copilot specifically, but I do hear a lot of complaints about Copilot and things like that as well. So this also kind of carries forward, guys, to Salesforce earnings after the bell today. They talk a lot about their Agentforce product, but they are also struggling to sell it too. Carl, I'll send it over to you.
It's a great point, Steve. Kramer's been all over whether or not Salesforce should change their name to Agentforce to emphasize the agents. Steve Kovac, thanks. Still to come this morning, ADP coming in worse than expected, as you might know by now. Evercore's Krishna Guha will join us with his take and what it might mean for the Fed meeting next week. Plus, a key part of the auto market's flashing a warning sign when it comes to the consumer. We'll talk about what has the street concerned. And the read on retail, from AEO's strong earnings beat to some changes at the C-suite over at Nike. Don't go away.
We are about 30 minutes here into the hour. Here are three big retail movers we're watching. American Eagle shares flying higher after a big top and bottom line beat, raising the guidance. The company CEO saying he's encouraged by the impact of collaborations with Sydney Sweeney and Travis Kelce and a new partnership with Martha Stewart. as well. Stock's up 14%. It's had a great run. Macy's reversing its pre-market losses after earnings guidance for the holiday quarter fell short of expectations. That said, they did post the strongest same-store sales growth in 13 quarters. And then watching Nike today, the company naming a new COO, a role that hadn't existed at Nike since back in 2023, while also eliminating their chief commercial officer and chief technology officer roles. Guys, what I can tell you is that this is just the latest leg in Elliott Hill, the CEO, who's been there for a little over a year's turnaround plan. It's a turnaround that he said would not be overnight and would take potentially several years. Clearly, they're not slowing down, they're moving forward. Some of these moves that they're making just try to flatten the organization. And that's what Elliott Hill said in a memo to his team overall. This is a matrix-y organization. I think the other important point here is that there are now no more key hires in top management by John Donahoe, the prior CEO. It's all of Elliott's people. And as you can see, I spent time with him, a few weeks ago at the headquarters talking through the turnaround. Part of it is just making this a faster, more agile and innovative company, and having now the geographies, for instance, which he consolidated into the geographical teams, report directly to him, he feels like makes sense. I mean, Mike, this is a guy who led certain geographies. He led the European market. Right. So having a layer between him and the head of that market just ultimately didn't make sense.
And elevating a supply chain person as COO, right? So
Correct.
That also shows a priority.
And also
there.
giving him the role of head of technology, which I think incorporates technology into every aspect of the business and everything they're doing here. Clearly, it's part of his plan to make things faster and work better at Nike. So yes. Yep. And also the chief commercial officer. Now, all that strategy and Nike Direct goes under the CFO, Matt Friend, who has also been in charge of strategy. Friend and Hill have worked together for decades at Nike, and clearly, have been working hard to try to get things moving again. There's some green shoots. I mean, we saw it in the last quarter, running, for instance, the U.S. market, but then there are others that are taking longer, like the China market. And Hill has sort of been transparent about the fact that this is going to take a little while.
All right, we do want to get to more breaking news on that Microsoft that we just told you about. Let's get back to Steve Kovacs. Steve.
Hey there, Mike. Yeah, literally as I was on air with you guys, Microsoft, a few minutes ago, Microsoft emailed me. They are kind of knocking back on this information report, saying they cut sales quotas for some AI products. Let me just read you what they told me. They say now the company has not lowered quotas targets for its salespeople, and they also mentioned or pointed out that the information just changed its headline on the story that said they lowered quotas. Now the headline reads, Microsoft lowers AI software growth targets. That is way different than sales quotas. So a little bit of nuance here going on, but the information did correct their headline, or change their headline rather, based on this new information Microsoft is saying. Microsoft now saying they have not reduced the sales quotas. I'm also expecting Microsoft to come out with some more information of this, but you can see now shares are reacting here a little bit. They were down as much as 2.5% last I looked, now down at more like 1.5%, guys.
I mean, Steve, obviously it's a substantive difference, but also shows you how sensitive the market is to just any slight change of the anticipated pace of growth in these areas, and who's relatively in and out, and whether we have to downscale our expectations for how quick this stuff pays off.
Precisely, and keep in mind, this was just one little product within the whole suite and portfolio of AI products that sent the shares down 2.5%. It's not even their main product. And again, like I said, when I was on a few minutes ago, the cloud business is doing great and growing like crazy. It's over $100 billion a year business now, in large part due to all this AI spending happening in the cloud. So yes, the market is incredibly sensitive to these kind of headlines, but just this clarification from Microsoft really does seem to be easing some of those fears, Mike.
Does, though, the thesis that there is frustration on some of the leading edge products within the enterprise, Stephen, that remains intact?
Yeah, that's absolutely. There's some questions about that, and again, I'll go back to what I told you last time, Carl, which was I talk to CTOs all the time, and they keep telling me, yeah, Copilot's good for some things, or maybe not, but they also say the outputs are not that great. Basically, the promise doesn't necessarily live up to what these kind of products can deliver, and they're seeing much more success building it themselves, and these kind of bespoke AI chatbots or agents or what have you. But by the way, when they do that, that is still to Microsoft's benefit, because they can choose Azure to run all this stuff on Microsoft's cloud. So even if they're not going out there necessarily and buying these products, it doesn't necessarily matter, because Microsoft still sees an upside on the cloud side.
It's interesting to see the underperformance of Microsoft. I mean, it's still up almost 15% this year, but underperforming some of the other competitors, certainly in Alphabet.
Oh, for
Thank
sure.
you, Steve.
Sure thing.
Steve Kovach, clarifying that Microsoft report, and again, as he said, easing some of the concerns about AI orders. Still ahead, Evercore's Vice Chair Krishna Guha breaking down this morning's rough jobs data. Don't go anywhere.
Welcome back. Some cracks in the labor market as ADP shows the number of badly missed expectations this morning, a loss of 32,000 jobs in November, while the street was looking for a gain of about 40,000. Here to help us break things down is Evercore's Vice Chairman Krishna Guha. Krishna, it's great to have you. Thanks for the help on this one, because the Commerce Secretary did tell us it might be related to the shutdown, but some of these small business cohorts are seeing negative prints, half a dozen months in a row.
Yeah, the small business community is clearly feeling a lot of pain right now. I think there are probably a lot of things going on there. One of them, of course, will be the pressure of tariffs on corporate margins. Much harder for smaller companies to just diversify their suppliers or make their suppliers eat some of those costs. When companies find that their margins are under pressure, they restrain the thing they can control, which is their headcount. More generally, I think, the small business community we know has been under quite a lot of pressure. It's a weak report, 4 out of the last 6 months in aggregate now on ADP, printing negative private sector. And of course, this isn't counting the government layoffs, which would be in the BLS report because it's just a private sector survey.
Right. So as we go into the new year and we do start talking about tax windfalls or at least better refunds and some depreciation schedules that'll be more favorable, can this be unwound, this weakness?
So I do think that the economy is likely to strengthen into next year. I think we will get a significant boost from fiscal in the first half. It might be something of a sugar high, really a powerful impact only on the first 6 months of next year. But during those 6 months, we think that you'll get about a 0.5 point of GDP boost to annualized GDP growth in the first half of next year. That's not nothing. I think you've also got some other reasons to think that the growth outlook will look better. You've got gradual fading of the uncertainty around Trump tariffs, ongoing strong AI-related capex. So I do think things can firm up some into next year. I would expect the labor side, though, to still stay relatively muted.
And if that's the case, Krishna, then how does that filter into what the Fed's going to do next year and perhaps what it ought to do after we get this cut, presumably next week?
Right. So in the very near term, I think this negative ADP print might temper just a little bit at the margins the hawkish side of the hawkish cut we expect to get next week. Now, when we say hawkish cut, what we mean is they'll deliver the cut with near certainty, but Powell will indicate that they've now completed the series of preemptive risk insurance cuts that they flagged back in September, and that from here policy will be data dependent, but in a more traditional way. That if the data is worse than expected in a material way, then they would cut, but not otherwise. I think they'll just temper that message just a little bit in light of this weakness. It could also mean that you get maybe one less dissent, right, than you would have gotten otherwise. It's the kind of number that might get Sue Collins, for instance, from Boston, on board with voting for a cut. Now, as we look into next year, I think the message will still be that the Powell Fed does not anticipate cutting again in January or March, or indeed likely for the balance of Powell's tenure. It will take some worse data to deliver that next cut. Don't expect the next cut will be preemptive. The next cut, if it happens before June and the new chair, will be a bad news cut.
Yeah, I guess it just depends who gets the top job to replace Powell.
So, I mean, I think it changes a little bit from, depending on who out of the advertised shortlist gets the gig. But I think we anticipate that almost by construction, whoever's chosen is going to be from the dovish side. In particular, is going to be a supply side dove. And so Kevin Hassett, for instance, in pole position, according to all the reporting, Hassett is somebody who believes that Trump tax cuts, Trump deregulation, plus the AI technology shock is going to allow you to run nominal GDP higher without overheating the economy. He's going to favor more rate cuts next year. So we're going to get next week the SEP, the old committee, a Powell committee, is going to pencil in one cut for next year. I think Hassett, probably the others, but let's say Hassett, would put down in his own mind 3 or 4 cuts next year. What you're going to get is going to be essentially a negotiated compromise between the new chair and the old committee, based on my economic outlook, where I do think we'll get some ongoing growth labor divergence given AI. I think we'll get 2, possibly 3 cuts as they split the difference.
It's going to be an interesting personal dynamic to watch as the new whoever it is moves in. Krishna, going to be an exciting week next week. Thanks so much. Krishna,
for sure. Great to see you.
All right, time now for a CNBC News update. Christina Partsinevelos has that for us. Good morning, Christina.
Good morning, Mike. Well, federal agents launched an immigration crackdown today in New Orleans. A Homeland Security official says the operation will target violent criminals. It's not clear, though, how many agents have been deployed into the city. It comes after similar immigration operations happened in Los Angeles, Chicago, Charlotte, and North Carolina. President Trump's pick to lead NASA, billionaire Jared Isaacman, is testifying right now on Capitol Hill before the Senate Committee on Commerce, Science, and Transportation. Isaacman, an ally of Elon Musk, was originally picked for the role back in May, but the president withdrew his nomination, citing, quote, past associations. He was renominated just last month. And Taylor Swift is no longer Spotify's most streamed artist globally. Hopefully she can shake that off. Puerto Rican superstar Bad Bunny is back on top after a 2-year hiatus, winning the title for the 4th time. Spotify dropped its annual overview of listening trends today, known as Spotify Wrapped, which you may start to see shared everywhere. In the United States alone, Swift still captured the top spot, followed by Drake, Morgan Wallen, Kendrick Lamar, and of course, Bad Bunny. Sarah, back to you.
I think she'll be okay. Thank you, Christina.
Thank you.
Still ahead, executives from Ford, GM, and Stellantis reportedly headed to the Oval Office today for a big announcement around fuel standards. We've got the details next. Plus, sports giant Fanatics diving into a new market, the predictions market. Their CEO of betting and gaming joins us on the news. We're back in just a moment.
With Tesla nearing a $1.5 trillion market cap, some are questioning whether the company is overvalued. We will talk to one strategist who is short Tesla. He'll tell us how far that he thinks the stock will fall in 2026. Tune in to our Market Navigator segment today on Power Lunch. That's at 2 p.m. Eastern.
Welcome back to Squawk on the Street. Executives from America's biggest automakers headed to the White House for a big announcement on some fuel standards today. For that, we're going to turn to our Phil LeBeau, who's with some details. Hey, Phil.
Hey, Carl, the president is expected to announce far lower fuel economy requirements for vehicles made here in the United States. Just for a point of refreshment, the previous standards announced by the Biden administration, I should say current standards, calls for 51 miles per gallon for a fleet-wide average for all the vehicles manufactured by a company by 2031. That's not going to be what we hear from the president today. He's going to be dialing this back considerably. We're still waiting exact numbers in terms of what the fuel economy standard will be, but the expectation is that you will see miles per gallon requirements come down dramatically from where they are right now. And then with that, they will also be easing regulations. That's been a big push from the Trump administration, telling automakers, we'll pull back on the regulations. That will help you on the cost front. Then there's the question of what happens to EVs? Funny that this is coming out on a day where Mary Barra, the CEO of General Motors, is currently talking with Andrew Ross Sorkin at the Deal Book Conference in New York City. He has been talking with her about EVs and specifically whether General Motors pivoted too hard into EVs and now has to reverse course. We're going to be listening to this to see if she has any commentary about the fuel economy standards before she goes down to Washington. At least that's our expectation, along with the CEOs of the other automakers. They're expected to be in the Oval Office at 2:30 this afternoon. Take a look at shares of the automakers and keep in mind that when you look at internal combustion engine vehicle sales in this country, it's about 80%. There was a big surge in EV sales towards the at the end of the third quarter. That has moderated. Hybrids are about 12-13% of the market. So what you're looking at is the fuel economy standards will be announced this afternoon. One other note, guys, and this data came out this morning. We highlighted on Squawk Box. The auto loan data coming from Experian, analyzing millions of loans in the third quarter. Average amount borrowed is close to a record high, now over $42,000, up $1,300 compared to Q3 of last year. And average monthly payment, $748, up $13 compared to last year. Sarah, I'll send it back to you.
Okay, thank you. A lot of good information. Thank you, Phil LeBeau. Now to some news around the prediction markets. CNBC can exclusively report that Fanatics is launching Fanatics Markets in partnership with Crypto.com beginning today. The app will go live in 10 states today and in 24 by the end of the week. CEO Michael Rubin teased that announcement with us a couple weeks ago in Vegas. And joining us now is Matt King. He is the CEO of Fanatics Betting and Gaming. Of course, our Contessa Brewer, who covers the space.
Contessa. Yeah, I mean, it's an exciting day for Fanatics because you're launching in about 10 states.
Correct.
Smaller states where you don't already operate the sports book.
That's correct.
What's the calculus?
So the calculus is like any product rollout. How do you start in states where it's smaller, there's some room for error because obviously we've tested the app, but it's going live for the first time. So really the intention over the next 72 hours is basically to be in 24 states.
You're the first sports book actually to launch prediction markets. We know that DraftKings and FanDuel intend to do so. FanDuel said a couple weeks ago it would be in December, but you're beating them to the punch. Have you lost first mover status to Kalshi and Polymarket by not getting there ahead of time?
No, I don't think so. I mean, this is really the top of the first inning on a market that's going to grow exponentially over the next 5 to 10 years. And so we're not worried about being a couple months behind them.
When we talk about the real opportunities, it's probably in the biggest states in the nation, California and Texas, that don't have sports betting. And right now, Hard Rock and the Seminole Tribe have a monopoly on sports betting in Florida. Prediction Markets offers a way into Florida that doesn't currently exist. Talk to me a little bit about what you think that means for the business of Fanatics Betting.
So for us, the way we think about it is, what do fans want to do? Why did we get into prediction markets? We got into prediction markets primarily because when you talk to sports fans, this is one of the things that they're most interested in experiencing, and we know that they want to do it from Fanatics. So for us, this was just a logical extension in terms of something new that sports fans want to have access to.
Is this a regulated market?
It is a regulated market.
By CFTC?
By CFTC.
So, I mean, do they go after things like insider trading?
They absolutely do. It's the same as insider trading in the stock market. It's frankly a federal crime if you trade on insider information. So it is absolutely regulated the same way that other large financial markets are.
Matt, you seem to think obviously this is an exploding area in terms of demand and there's going to be room for lots, but is there any company that you can say, or do you believe you have an edge aside from you have a customer base and a brand? Or I mean, what's going to determine winning and losing as a prediction markets venue?
All of these types of products all come down to the product offering and the customer proposition. We think we can deliver the best in the industry, and that is a combination of brand, the app itself, How do you provide rewards around that and really kind of holistically present that to the customer? And as you've seen in our sportsbook business as well as our iGaming business, we're the fastest growing, we can take what Fanatics has to offer and turn it into something that's really compelling for customers.
Is the margin structure much different in prediction versus sportsbook?
It is very different in the sense of, on a kind of dollar of contract volume, your revenue margin is a lot lower, but your gross margins are a lot higher. And so, because you have less cost to run the business.
Less cost?
Yeah.
And that's because?
It's because when you work through kind of all of the different fees and everything else that go into running a regulated sports book, it's just a different cost structure relative to what we do day in,
legacy
day out.
business.
Yeah.
Kalshi just raised $1 billion, some new investors like Kathy Woods Ark, and now the valuation has more than doubled to $11 billion. Is there a trajectory that you can apply to the Fanatics business because of predictions based on those valuations?
We're not focused on short-term valuations. What we're focused on is how do I build a big profitable business long-term over the next 10 years? And so our focus is the same thing as it's always been, which is how do you develop the best customer proposition possible? And then ultimately, how do you be a top player in the market?
Thank you very much for joining us. There's still a lot of regulatory backlash. The Southern District has issued a class action lawsuit against Kalshi for duping customers. This is not a settled thing on the sports side of it, but the prediction part of it and the urge to bet even on cultural issues or politics, I think is real.
For sure.
Or what's going to be said on a conference call.
Yeah, right, exactly.
Thanks. Good to see you.
Good to see you.
Key test for the AI trade when CRM reports in just a few hours. We'll talk about what to watch for after the bell tonight when Money Movers begins in a few moments.
Good Wednesday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, the flashing AI warning signs. Microsoft pushing back on reports of lower AI software demand. NVIDIA seeking to defend its AI moat. And we are joined by a former OpenAI senior executive as the company reportedly declares a code red.
Watching energy today, Nat Gas above 5 for the first time in a few years, continuing to rise. Kramer calls it unnaturally high as it got close and did achieve that 5 handle. We're joined by the CEO of Williams later on today, the Nat Gas giant.
And Redfin forecasting what it's calling a great housing reset next year. We're joined by its CEO to discuss the state of the market and the real estate consumer.
Bit of a limited range in stocks today, although the Dow's up almost 200. We're holding 6840 or so. Most sectors are green with the exception of some information technology. The Microsoft scare market's still shaking off. VIX below 17.
We'll start with this morning's weaker than expected ADP data led by small business job cuts, something we asked the Commerce Secretary about, Howard Lutnick, last hour. Listen.
No, it's not tariffs. Remember, you had the Democratic shutdown, right? And and then remember, as you deport people, that's going to suppress private job numbers of small businesses. But they'll rebalance and they'll regrow. So I think this is just a near-term event. And you'll see as the numbers come through over the next couple of months, you'll see that all pass.
For more, let's bring in CNBC senior economics reporter Steve Leisman, who has more on this morning's numbers, Steve, and what the outlook looks like.
You know, Sarah, the problem for the Commerce Secretary's explanation is this, and we'll see it in a second on a graphic, but the downturn in small business hiring in the ADP data long predates the shutdown. But first, as Sarah said, a big miss on ADP with the payroll company saying private payrolls declined by 32,000 in November, the fourth negative number in the past 6 months for this series. Total private payrolls down 32,000. Estimate was for 40,000, and you can see goods sector getting hit and the service sector both getting hit. But the big story here, as Sarah also suggested, small business down 120,000, medium and large size businesses doing okay, up 39,000, 51,000 for medium and 39,000 for large business. Now take a look, virtually all of the job losses are from the small business side, 1 to 49 employees. They have been negative in 6 of the 7 months going back to April. Before April, they were routinely positive. Without those job losses, overall job growth would have been positive. So these numbers have been lousy since the tariffs were put in place. Causation, correlation, I don't know. Take a look at by sector here, education, healthcare, and leisure hospitality both doing well. But manufacturing off in a big way, information and professional business services also off as well. Other data confirms the struggles of small business hiring. There's a company called Homebase that we follow. They're a payroll company as well. They say hours worked fell 3.1%, one of the largest pullbacks in recent years, a result of businesses heading into the holiday season with a reduced workforce and actually actively reducing that headcount ahead of the holiday season. What's it all mean for the Fed? The weak jobs data confirms market expectations for that rate cut, up near 90%, Sarah, as you know, going into the December meeting next week.
Yeah, I do think one question is whether it sways some of the non-cutters, like a Susan Collins that we saw going into the meeting, to have a weak number like this. But Steve, you know, I think, you know, maybe it's having trouble adapting to tariffs on small business, but there actually are quite a few headwinds that have been with us for the last few months. I think one thing we have to mention is small business also tricky with, you know, tighter credit conditions and higher interest rates. I mean, that has been a running theme that we've seen in recent years with small business as well.
No doubt. I think there are other headwinds out there. And I don't think the secretary's totally wrong. Deportations, immigration also playing a role. The shutdown might have played a role, though I doubt it was extensive and national as a result, maybe playing on optimism or the sense of optimism out there for business. I think that's an important factor. But I really think that, and I've been talking about this for a long time, Sarah, it's not hard to imagine that small business has a much tougher time dealing with not only just the tariffs, but the incredible changing tariff landscape on almost a daily or weekly basis, much more difficult than large businesses have. They can't adapt. They don't have a department that says, let's get it from Vietnam instead of Indonesia. Large businesses can do that.
True.
Small businesses take the price that's been given to them. So I think the Secretary ought to have an open mind for the possibility that tariffs are playing a role here and think about some relief for small business in this regard.
Well, that brings us to IEEPA and a SCOTUS decision, and both the Treasury Secretary and the Commerce Secretary saying today that they can recreate that exact structure if the decision goes against them, which in itself would create incremental uncertainty. Steve?
I mean, there's a reason why, Carl, that we follow a thing called the Economic Uncertainty Index, and it is very elevated, and there's good data that shows that there is an economic impact of elevated uncertainty. I had advocated from the very beginning, Carl, for what it's worth, which I guess is not a whole lot, that the president ought to run these tariffs through Congress. And running them through Congress, and I just talked about this at the CFO Council, running them through Congress creates the stability that businesses need to know these things are in place. Tell me something, are you going to sit there and break ground right now on domestic production, not knowing if the tariffs that were supposed to protect your domestic production will be in place next month or next year or in the next administration? If you run it through Congress, whatever your thoughts are on tariffs, you get the stability that businesses need to figure out how to invest.
Yeah, but then you might not get it passed, I think is part of the concern
well, if
here.
the peoples don't want it, the people shouldn't get it. That's what the House is for, right? It's the people's house.
Steve, thanks. Really getting into the nitty-gritty on tariff theory. Steve Leisman at the CFO Council today. Staying on the market, our next guest expects the S&P to contract to 6,350 over the next several months. Joining us this morning is Stifel's Chief Equity Strategist, Barry Bannister. Barry, it's good to have you back. Good morning.
Hi.
You've had I would argue, sort of sense of caution throughout this year at least, which hasn't necessarily paid off, but you're sticking with it.
Well, I kind of feel like the lemming in the comic book strip where it says the lemming stands up and says, "Wait a minute, what are we doing here?" There is an awful lot of ebullience in the market. The pullback call initially was it didn't look like the Fed was going to cut as much, but then to the day, November 21st, that New York Fed President Williams said, "Yeah, we're going to cut." We took the odds back up, and that reduced the near-term pressure in the market that we had seen after October. Right now, I think the bigger concern is at what point does the market, with this poor data that we're seeing, start wondering if the Fed is too late?
So does the downside get led by the riskiest parts of the markets, which arguably are already in the process of correcting?
Yeah, I mean, clearly the more cyclical side of the S&P 500, and I would include tech and cyclical. I mean, it's a big discussion, but the whole economy now is acting like a tech stock. It's high-end consumers from wealth effects, it's data center construction. We're a hostage to a tech stock. And, I've done this a while. I know that technology is great, but it's a bet the farm, winner take all industry. And to model a whole economy on that is going to introduce a whole new level of risk on top of what Steve was talking about on policy. So for me, it's just a concern about the economy. We're seeing unemployment is most definitely going up. It'll probably go close to the 5% post 1955 70-year median of 5%. And when that happens, consumers will pull back, and that's 68% of the economy. It will affect big tech and their core businesses, which is advertising.
But I guess, I mean, part of the bet is, Barry, that technology can help make up for it, whether it's capital spending, whether it's productivity wins, higher growth, all of that offsets maybe a weakening labor market and some of the policy uncertainty. That's been the story of the year.
There was an old movie called Field of Dreams, and the line from the movie was, build it, the baseball field, build it, and they will come. That's what I think AI has been. They don't really have products, and they're spending almost half as much as the United States spends each year on entire residential construction market. So that's a lot of money. To crunch the data with semis and to move the data around with cloud services is not a product. A product will be the software that comes out of the AI, and I don't know if they've got the moats or the core monopoly business big tech margins on that product. So this is the first time in history we've spent this much money not knowing for sure what the demand picture would look like.
Right. I know you're also, if we're going to talk about the promise of AI productivity, that some action in, say, gold, best performing asset of the year, might argue the other direction.
Yeah, we you know, it works in 10 years. It worked on 125 years. If you look at the ratio of oil to gold, it lines up perfectly with productivity growth. Productivity is output per hour worked, how many units you make of anything in 1 hour of time. And it lines up. So you'd have to believe to be long oil, short gold, to believe in a AI-driven productivity story. But either gold tanks or, you know, oil goes up on strong global growth. If that happens, it's inflationary. Just overlay CPI against the price of oil. It's not a good thing. So we're at the lowest point since the Great Depression on the oil to gold ratio, the lowest point since the early 1930s. So something's got to give here.
Meanwhile, if you're right about the direction of the indices, where would you imagine the bargains come from? If you got a weakened consumer, can you rely on defensives?
You know, it's funny because, you know, we've really paid up in the market for the tech growth promise story. The non-tech cyclicals are probably based on these PMI readings and what's going on in China. There's very little stimulus there, and it takes them 8 months before their stimulus even pays off for global purchasing manager index cyclical measures to work out. So non-tech cyclicals, it looks too early. Tech looks very extended. So that just leaves you on a pullback with defensives, and that's what would probably hold its value in any sort of a pullback. Now, as we go into next year with earnings growth, yeah, provided there's no recession or near recession, you could see earnings growth with PE compression, the market multiple comes down, and you could make a case for up market. But at this point, I think we're in a digestion phase for the market. You know, all the news that's come in, the earnings that are expected, the hope, the dream on AI. I think we're going to have to digest these levels for a while.
Right. Well, we've talked a bit about sort of the challenges of midterm years on the markets, and certainly there's no shortage of aggressive targets for year-end 26, Barry. We'll stay in touch. Good to see you again.
All right, man. Good to see you, Carl.
That one stands out. More sour. After the break, Michael Dell weighing in on what he sees as the biggest concern in the AI build-out. Those comments next.
CEO of Williams is with us, handling a third of all nat gas in this country, with prices now at the highest level since 22. Talk about how AI is impacting that outlook when Money Movers continues.
Welcome back. Michael Dell making huge news yesterday, announcing he is donating more than $6 billion to fund Trump accounts for millions of kids. I spoke with him yesterday afternoon, where we also discussed, of course, the AI investment cycle and some of these bubble concerns. Listen.
If you think about the $114 trillion economy that we have, you know, roughly 2/3 of the economy is based on knowledge work or services. And if that knowledge work and services can be improved and made more efficient and more productive by, let's say, 5%, the amount that's being invested in AI could actually be not enough. And at least I can tell you from our business, when we talk to the neo clouds and the sovereign AI opportunities, and certainly the growing demand from enterprises as they begin to deploy AI, there's a tremendous amount of demand out there, and I think it will continue.
So you're not worried. You're not worried about the bubble concerns, the competition that's emerging, the code red for OpenAI. You know, this is all the latest market fixation.
You know, there will be lots of companies, you know, playing in this space. I would tell you the big concern right now is that there's actually not enough capacity in the advanced node semiconductors and the other components that we need based on the demand that we see. It looks to us like 2026 will be a year where there is more demand than there is supply.
Joining us now, global AI advisor and former OpenAI head of go-to-market, Zach Kass. Zach is also the author of The Next Renaissance, which will be released in mid-January. It's great to have you. You know, contrary to market concerns lately, Zach, Michael Dell is saying the problem is there won't be enough spending. There might not be enough investment, not enough capacity. The market's sort of questioning the opposite right now. Where do you think it stands?
Well, I'm pretty willing to, I mean, I'm not going to argue with Michael Dell on a lot of these issues. I think, first of all, I totally agree that I think that we don't actually have the infrastructure that we will need to deploy the AI systems that we want. And I think it's actually going to be an energy constraint. Like this, it seems glaringly obvious if you stare at this even for, you know, an hour, that the rate limiter is going to be energy. We thought we needed 40% more energy at the beginning of the decade. Now we think we need 1,000% more energy. Where does it come from? We need a step function improvement. And when you talk about the constraints, I actually think it's not necessarily semiconductors, it is the power supply. But I agree that we are probably going to want more of this than we are currently building for.
So talk a little bit about what you did at OpenAI and when you left and why you left.
My job was to help build sales solutions and partnerships. I was one of the early employees and one of the first business hires, and had the incredible privilege of sort of helping the world graduate from its understanding of GPT-3 to then GPT-4, and then of course 4.5 and on, and got to grow the company from millions to billions in revenue, and went home actually to Santa Barbara because I'd been talking for so long about the future of abundance and the importance of physical community, and woke up one day and realized I actually wanted to build a life in my hometown, which is the greatest place on earth.
So when you see a report like yesterday's that Sam Altman is declaring code red over the next model as competition heats up, what does that mean to you?
Well, again, I cannot confirm that this announcement, although it seems like the Wall Street Journal has. What I think is important to remember right now is that we are sort of now measuring OpenAI on a lot of axes, and to the company's unending credit, it is basically attacking a hardware space, it's attacking data centers, core models, agents and tooling, hardware, the consumer app, of course, search, and maybe, it's rumored, eventually advertising. That gives a lot of space. And anytime we build these companies up, we see sort of space start to cede, companies can get pretty nervous. I think what's important to remember is that OpenAI has done so much incredible work, and it has incredible expectations for itself. Frankly, Gemini 3 is an incredible product, and it's a reminder that the market is just improving a ton right now. And I think that's a pretty exciting trend for the average consumer.
But there is this question around where OpenAI ultimately will sit against the competitors that are spending more, but are more profitable and already have huge enterprise cloud businesses and sort of are going at the same rate, if not faster, on the models for AI.
Well, Sarah, I agree that the competition landscape is massive. I also agree that Google is the 800-pound gorilla. I'm not sure that I agree that it is obviously outperforming OpenAI, and I think this is where my disagreement with sort of the average person who points at this issue comes in, which is that ChatGPT I still think is a better product, but it also is going to continue to get better. What I think, Jim Cramer, I like Jim a lot, yesterday said, when is OpenAI going to admit that it's falling behind? There is a very good chance that OpenAI releases a better model than the Gemini 3 model that exists today very soon. And at that point, then the market is going to respond and say, oh, look, my favorite team is ahead. My point, I think, right now is that we're spending too much time actually trying to watch this play out like a basketball game, teams trading buckets. And actually I think there's an importance to zooming out here a little, because everyone knows that second quarter, just because your team went on a 6-point run doesn't really mean anything.
No, that makes sense, and you're right. There's been a lot of lead changes in this quarter, but I think the bigger story is that one team appears to be playing all of their starters with not much of a bench, and some of these other players have multiple benches. Isn't that a concern?
Well, yeah. I was trying to think of a good basketball retort. Look, I mean, again, the world's best talent wants to work in this field, and you're sort of splitting hairs when you talk about the actual talent benches that exist inside of companies like OpenAI and Google. Again, it's true. Google has a lot more money. I'm not sure that makes anything better. OpenAI proved when it was just 90 people that it could launch GPT-3, which changed the world in many ways, and ChatGPT with less than 200 employees. So I don't think that number of players on the bench, if we're going to continue this analogy, is the important thing. Focus matters, research breakthroughs matter, enterprise motion matters, and what I think is still true, and Michael Dell pointed this out, we're seeing enterprises flood the zone right now. I think demand is still scratching the surface on a lot of these things, especially, by the way, in fields like healthcare and financial services, where I think we're going to actually see major adoption over the next 2 years.
If this internal memo is correct, and this notion of sort of pushing back advertising or pushing back devices in favor of refining the model, do you think that's wise, given there's so much concern about long-term profitability?
I'm not a corporate strategist, so it is very hard for me to actually make an assessment. Here's what I would say. I think it is very true that there will need to be more money introduced into the space on a multiple basis. And if you are going to build infrastructure, if you're going to build your own chips, if you're going to build your own hardware, if you're going to build your own applications, and OpenAI is signaling that it is doing these things, it doesn't want to lose a lot of ground on anything, but it also has to make some pretty serious bets. And what I can say is it's a company that is very good at delivering when it is very focused. And right now, I think that there's like a pretty good argument that there are some things that it should focus on.
But don't you think when it comes to the competition on enterprise, it is, a story of winners and losers? Because and does OpenAI have a competitive chance there when Google and Microsoft and Amazon are so enshrined in the enterprise software business already?
Well, look, before Google, there was someone else. There is change happens. I try to remember and remind everyone to zoom out a little. A lot of the companies that we're talking about as 800-pound gorillas did not exist until very recently, and actually very recently. I remember on maybe not your segment, but a similar segment, everyone saying, "Oh, Google's done," right? Google fell behind in the AI race. It's too late. Search. They'll have to kill search in order to do anything.
Just a few months ago.
So my point is look. Right now, I'm super happy to be here to talk about this, but I do want to remind everyone that there are serious issues that I think should be addressed. One is the infrastructure that we're going to need, chips and compute, or chips and power. One is policy decisions that we need to start making right now, and frankly, that I don't know that we're sort of thinking about and talking about well enough. But the trading baskets. Look, I am super excited for all the companies in the category right now, because I do think we are just not even beginning to appreciate how much demand there will be for this. In the same way that I think we didn't know how much demand there would be for the internet or modern compute or frankly electricity.
Yeah, I mean, echoing Dell there at the top. Well, Zach, it was really good to talk to you and very valuable to hear your perspective. Zach Katz.
Thanks, Sarah. Thanks, Carl.
Thank you.
When we come back, Microsoft pushing back on some of these reports about a slowdown in AI software sales, but competition does remain a concern. We'll talk about that next.
Plus, CEO Brett Finn is with us. New mortgage app data released this morning. How rates are impacting demand. Stay with us.
Microsoft shares under some pressure, but off of the lows of the day after reporting from our own Steve Kovac. Microsoft pushing back on these reports that has lowered its AI software sales targets. The company out with a new statement a few moments ago saying the information story inaccurately combines the concepts of growth and sales quotas, which shows their lack of understanding of the way a sales organization works and is compensated. Aggregate sales quotas for AI products have not been lowered as we informed them prior to publication. The information updating its headline to say instead that it's lowering its software growth targets. Meantime, we're getting some fresh data from Ramp on enterprise AI spending and what it might mean for the so-called agent economy. And for that, we'll turn to Deirdre Bosa and today's Tech Check. Hey, Dee.
Hey, morning, Carl. So what the data shows is that this isn't just a Microsoft story. This may be a reset moment for the agent economy at large. Even Sam Altman, in his internal code red memo that we've been talking about, he said that OpenAI will shift resources away from agents to fix the core ChatGPT experience. So you have two of the biggest AI players tempering expectations around these new agent products, or put simply, workflow automation. Now, that new data from Ramp, it shows, however, that Anthropic just saw one of its biggest monthly gains in AI enterprise adoption, while OpenAI, still the leader, is seeing its growth moderate. But it isn't chatbots or agents for Anthropic. The data says that the real growth is in API spend. So put another way, guys, agents are top down. They're sold to executives. APIs, they're bottom up, adopted by the builders at these organizations. And that is a key distinction, because enterprise agents, they may be hitting friction, but usage as a whole is not, and that is where Anthropic is winning. Now, it raises big questions for Microsoft. Did it bet too heavily on one partner? It spent the last few years building its enterprise AI story around OpenAI, but the fastest growing enterprise model today is Anthropic's Claude, and Microsoft knows it. Last month, the company announced it will invest up to $5 billion in Anthropic, really a clear move to reduce its dependence on OpenAI and cover its bases in a multi-model future. It's worth pointing out, Amazon got there first. AWS has been Anthropic's primary cloud and training partner for years, and with enterprise adoption accelerating, according to that data, that early bet is looking more and more strategic. So, guys, the bottom line for investors, that early hype around agents was hype, but the real money right now is in model usage. That doesn't mean that agents won't get there, but they may be proving more complicated to deploy at scale than people appreciated. I had one person in tech tell me that it's not the year of the agent, it's the decade of the agent. So that could imply investors may have to wait a little longer to see that ROI.
And how does it work with the companies? I mean, how competitive is it really? We were just having this conversation with someone who worked at OpenAI, but are these companies using multiple agents and multiple companies, like an Anthropic and an OpenAI and a Microsoft? Can they employ them all, or is it just one versus the other, whichever has the better model right now?
Yeah, I mean, you hear often that kind of enterprises are model agnostic. They'll use the one that best serves their purposes. But what I hear is that in a lot of those cases, it ends up being Claude. You know, enterprises, developers, Claude seems to be gaining. And also, it may lead to profitability sooner, right? When you have this dynamic of when will or won't OpenAI and Anthropic go public? Could they IPO around a similar timing? Obviously, the profits piece is going to be extremely important. I think it was a journal report not too long ago saying that this enterprise adoption and the popularity of Claude may actually help Anthropic get there sooner.
Dee, really interesting, and this little drama by The Information definitely added to the color today. That's our Deirdre Bosa. Let's get a news update with Christina Partsinevelos. Hi, Christina.
Hi, Carl. President Trump today pardoned Texas Democratic Congressman Henry Cuellar and his wife, who are charged in a federal bribery and conspiracy case. In a post on Truth Social, Mr. Trump cited a weaponized justice system, claiming Cuellar was being prosecuted because he was critical of former President Biden's immigration policies. Switching gears completely, Google announced today that it will comply with the world's first teen social media ban in Australia, and they're going to lock out YouTube users who are under the age of 16. Facebook, Instagram, TikTok, and Snap have already said they would also comply. The law bans platforms from allowing kids under 16 to have accounts and is closely watched in other countries considering similar bans. And Hyundai will start selling a four-wheeled robot powered by artificial intelligence next year. The mobile electric droid, that's what it's being called, is the automaker's first mass-produced mobility product. It's essentially a platform with wheels that you're seeing on your screen, but Hyundai says it could potentially be used for everything from deliveries to filmmaking. Keyword could. Sarah?
Okay. More automakers getting into robots. Thank you, Christina. Dell.com, natural gas at its highest level since 2022, with colder forecasts lifting prices here. We'll get to the impact from AI power demand as well, with the CEO of Williams handling a third of all natural gas in the United States. That's next. Welcome back. Take a look at natural gas topping $5 for the first time in 3 years as colder temperatures set in across the U.S. Between the weather and then the growing power needs for AIs, where should you expect prices to go in 2026? Joining us is Williams CEO Chad Zamarin. The company delivers roughly a third of all natural gas in the United States with more than 30,000 miles of pipelines. So do you expect these higher prices to stay, Chad?
Yeah, thanks for having me, Sarah. You know, we are entering the highest demand time of the year for natural gas, and so we have seen gas prices, you know, get to $5 per MMBTU. We don't expect that to last, you know, long beyond the winter time. And in fact, forward markets are showing that we likely see gas prices come back down into a range of $4 to $5. It is important to note that still at $4 to $5 natural gas on an energy equivalent basis is about 50 to 60 cents per gallon of gasoline on an energy equivalent basis. So it's still our most affordable energy resource we have here in the United States. But we do see the winter, you know, colder than maybe normal, going to drive some additional demand this winter, but we should see prices stay in a moderate range over the long term.
I was just going to ask, how does demand look overall into 2026?
Yeah, demand is strong. I mean, we have ramped natural gas. We've grown demand in the United States by 60% over the last 15 years. That's a lot of demand growth for a very large sector of energy in our country. And now we see LNG exports continue to ramp up through the end of the decade. And importantly, we're seeing AI and the race for build out of data centers and data center capacity. It's going to have to largely lean on natural gas as the most dispatchable, reliable, and clean energy resource we have that we can bring to scale quickly. And so we're going to continue to see a lot of important, strong demand for natural gas.
Chad, if demand is so strong, why would we be looking for much relief on price, even once we get past the seasonals?
Yeah, I mean, Carl, the great reality is we've got a tremendous amount of supply in the United States. The challenge when it comes to price is not having the ability to produce low-cost supply. It really is having the infrastructure in place. And I know I heard, you know, one of your prior guests talk about the constraints for the build-out of AI, and it's not an energy supply issue. It truly is an infrastructure issue. It's our ability to get energy produced affordably, but then get it delivered to where and when it's needed. That's really the challenge here in the U.S. You know, I'm here in Washington, D.C. Congress is working on permitting reform. That's one of the most important things Congress could do for our country from both an affordability perspective and from an AI reaching our full potential perspective, is pass meaningful permitting reform so we can build the infrastructure we need to bring energy supplies to markets that need them.
We've seen, you know, we're monitoring pretty well the horse race of energy suppliers for the next 5 to 10 years. And I'm wondering if you've seen any kind of degradation in the argument for, say, nuclear, whereas given the immediate availability of nat gas.
Yeah, I think the reality is we need to be exploring every possible energy solution we can. You know, I've mentioned before, we haven't grown electricity production in the United States in 25 years. I mean, that is a shocking statistic. In 25 years, we haven't grown electricity production. Over that same time period, you know, we know China has grown almost 10 times their electricity production. They now dwarf us from the perspective of producing electrons. And when we talk about the next generation of technology and opportunity, we're going to need to get back to growing our electricity production capabilities here in the United States. And so we're going to need to explore all technologies. But the reality is we don't see nuclear playing a meaningful role in the next 5 to 10 years. We're going to have to lean on natural gas as the most dispatchable, also the most affordable resource that we have. And so I think over the long term, nuclear, I hope, will play a meaningful part. But certainly as we look to the next 5 to 10 years, we're going to have to lean into natural gas in a big way.
So how much is AI empowering those data centers is driving your business right now? How big of a part of it, and how big does it get?
Yeah, it's pretty meaningful. You know, when you think about natural gas demand growth in the U.S., right now we do have a large LNG export ramp that's happening, which is good. That way we can supply American-made energy to our friends and allies around the world. You know, important to remember that we were able to double LNG imports into Europe when Russia invaded Ukraine, so that's very important. But for AI, we've got to scale power, and the fastest way to scale power in the U.S. is with natural gas infrastructure. The challenge is expanding the grid is a very slow and cumbersome process. So in many cases, we are building projects both to expand our networks and grow the grid over time. Those are going to take 3, 5, 6 to 10 years in some cases. So we're also taking projects that bring natural gas directly to data centers. We can put power on site, doesn't burden the consumer We can bring excess power over time, ideally even lower cost for consumers, but make sure data centers can scale up. We've got several projects across our footprint where we're doing that.
All right, Chad, thank you for the update. It was good to talk to you.
You too. Thanks, Sarah. Thanks, Carl.
Chad Zamarin, the CEO of Williams.
CEO of Redfin's coming up after the break. We just got some new mortgage app data this morning with mortgage rates moving a little bit lower in the past week, although still some challenges on that front. Stay with us. Welcome back. Prospective home buyers getting some relief as new data shows mortgage rates did tick lower last week, with affordability a major focus nationwide. Our next guest predicts that 2026 will be the year of the, quote, great housing reset. And joining us this morning is Redfin CEO Glenn Kelman. Glenn, we are always grateful for your insight. Good to see you again.
Great to be here.
So what brings about the reset? It sounds like you think the idea that incomes grow faster than home prices is kind of important.
It is. The housing market has been going down for 3 or 4 years straight. 2026 is going to be the year that things start to get better. It's not going to be some overnight sensation, but it will be an improvement where home prices grow 1% and wages grow 3 or 4%. That means that housing will get slightly more affordable. And that's good news because America needs a break. Housing prices have been going up, even as sales have been going down.
It doesn't sound, though, like you think the 30-year fixed gets much lower than 6.
It could dip below 6, but just averaging around 6.3, which is what we predict for 2026, will be a material improvement from 2025. We've been stuck at 6.6 for most of the year, so if we can just stay where we are now, or maybe go a little lower, we'll take it.
What the administration is clearly very focused on housing affordability. Commerce Secretary Lutnick addressed it in our interview this morning. They want to see lower mortgage rates. They want to see more supply of homes. I mean, both theoretically would help. Glenn, what do you think is the best policy? What can they do to get the market moving here?
The simplest policy change we could make is to make it easier to build housing. And this is an issue that unites Elizabeth Warren on the left and Donald Trump on the right. You can't find many other issues like that. For the longest time, Americans have been divided about whether we want more home construction because, of course, homeowners worry about how it will affect their prices. But now I think the country has got the bit between its teeth, and we are going to build significantly more housing. It won't solve the problem overnight. No one can. But it is the beginning of a new consensus around affordability. And I think what's interesting about it is that it isn't just home prices anymore. It's utility bills because AI data centers are competing for electricity. And it's also home insurance rates because climate-related natural disasters have made it very expensive to live in the West, very expensive to live in flood-prone areas like Florida. So we are seeing people look at more than just the home price when deciding, can I afford to live here?
A couple questions on multifamily, Glenn. We have had apartment rents decline month on month for 4 straight months. The multifamily vacancy rate's at 7, pretty high. But I'm not sure you think apartment rent relief is going to last.
Yeah, that ain't going to last. So the people building apartments have really slowed down construction, and that means that as supply dwindles and demand remains steady, we should see rents increase. For the longest time, there was an apartment building boom, not in the for sale market, but in the rental market, and that really kept a lid on rents. We are seeing more millennials and Gen Z folks living with their parents, shacking up with roomies. Homeownership rates are very low, so that has suppressed rent increases, but it can't last forever.
Yeah, and driven up the age of first-time home buyers. Glenn, I just wanted to ask you about our colleague Diana Olick's article she put on CNBC.com that got a lot of attention, citing your data on delistings. 85,000 U.S. sellers taking their homes off the market in September, up almost 30% from the year before, and the highest for that month in 8 years. What does that tell you about the market? What are we seeing there?
Never question Diana Olick. She has been on this beat forever. She knows everything. And in this case, she's citing us. So how could I disagree? It's an 8-year high. We see some sellers panicking where they see really good listings that aren't selling. Their own home is getting marketed like crazy and still not moving. And so it's normal at this time of year to delist properties and try again in January or February. But even accounting for that seasonality, it is an 8-year high. And that is just because the market is in transition. So buyers are looking forward 6 months, saying, if I wait, time is going to be on my side. I'm going to get a better deal. And sellers are looking back 6 months, thinking, I wish I'd sold at the beginning of this year instead of being stuck at the bitter end. And so it's a real tough time in the market. There's always a reset coming into the next year. I don't think the rate decreases have affected the housing market because they came too late in the season. But if we start next year with a rate closer to 6.0, we are going to see more home sales. It's just almost a law of physics.
Yeah, interesting. Spring is going to be important, Glenn. Really good insight and information, as always. We appreciate it. Good to see you.
One more prediction. Peace and love in 2026. It's going to be so good next year.
Oh, that's good. We'll take that one, Glenn.
Peace and love and a housing reset. That is so Glenn Kelman. Thank you. When we come back, a big test for Salesforce and its AI strategy. When it reports later today, the stock's been an underperformer this year, down around 30%.
Plus, Palantir's Alex Karp on stage at DealBook this hour. You'll hear what he had to say on China competition in the AI race.
primary and most important adversary, I say adversary consciously and not enemy, is China. And we will decide, AI and the ability to implement it on the battlefield primarily will decide the values, i.e. the norms, the laws, and the spirit of the laws that are imposed upon us across the globe. And if you think for a minute they believe anything that we're being taught in our idiotic faculty, you are even more idiotic than the professors teaching it. And I'll tell you, if you actually believe in these values, again, I'm not a neocon, I never was. That's why I'm skeptical of immigration, because I don't think all this cultural assimilation hasn't worked in the last 50 years, and that's an obvious truth you're also not allowed to say. I'm skeptical of imposing values on other people. I never believed we should or try to make the Arab Middle East, Wilsonian people, like a Wilsonian ideal imposed upon them. If you believe for a second that anyone else outside this country believes that we are going to defend our values without superiority and moral violence, you're just living in a world that doesn't exist. It does not exist.
All right, all of Karp's sort of worldview is wrapped into that one soundbite. It was Palantir, of course, founder and CEO Alex Karp on stage at DealBook with our Andrew Ross Sorkin earlier this hour, talking quite a bit about the relationship between the U.S. and other countries. We'll bring you all the highlights from DealBook throughout the day here on CNBC.
Yeah, it's been a busy morning for Andrew, that's for sure. Meantime, Salesforce looking to change the narrative around its AI strategy tonight when it reports results, and Seema Modi's got a curtain raiser on that. Hey, Seema.
Sarah, CEO Mark Benioff has been championing this idea, right? That Salesforce's AI agents can automate tasks, make businesses more efficient, and in some cases replace human talent. And while the company has had a number of early customer wins like Williams-Sonoma, FedEx, investors tonight want more concrete evidence of adoption. Examples of how businesses are integrating these agents. Citi analyst Tyler Radke spoke to 3 Salesforce partners recently, and he walked away with what he calls cautious feedback, noting smaller initial commitments from customers, limited anecdotes of Agentforce use cases. Beyond AI, there are a lot of competitors trying to steal market share from Salesforce's core software business like Monday.com, ZoomInfo, even Snowflake. Gil Luria at D.A. Davidson says he'll be looking for clues as to how Benioff is navigating this threat. And guys, there's also some chatter about whether Benioff's recent social media post in which he praised Google's Gemini 3 is a preview of some sort of type of deal or partnership in the works between Google and Salesforce. So we'll keep an eye on that and more.
Yeah, it's kind of become a benchmark of a barometer of how the market feels about some of these software stocks on the software versus AI trade. Seema, thank you.
Plus, it was probably the most unadulterated endorsement of Gemini that we've had so far.
Yeah,
when he said, I'm not going back.
He's also, though, endorsed Grok in the past and Musk and those models. So, I mean, he clearly has his finger on the pulse of what's happening and who's leading on technology. It will be interesting to see if they start to announce some deals, in other words, powering their Einstein AI agent.
Yeah, obviously markets got just hair trigger response given Microsoft's example today on the heels that it reported the information. Yeah, absolutely. Holding on to 68.35, Dominic Chu in for the judge.
All right, thanks very much, Carl. Thank you, Carl. Thank you, Sarah. Welcome to the Halftime Report. I am Dominic Chu in for Scott Wapner today. Front and center this hour, the setup for stocks into the year end. The investment committee is standing by with their playbooks. So joining me for the hour are Joe Terranova, Stephanie Link, Jim Lebenthal, and Bryn Talkington. So let's get a quick check on the markets right now as things stand. It's a relatively calm one. The Dow's up about 0.5% to 47,686. The S&P 500 holding on to that 6,800 level, 68.36 the last trade there, just about 0.1% gain there. And the NASDAQ composite just about flat, drifting between marginal gains and losses at this point. The Russell 2000 small cap index up a blistering 1% in this market here. We're going to have more on that in just a moment, but first we're going to kick things off with a big committee move. This is Bryn throwing in the towel, so to speak, on Salesforce ahead of the earnings report after the closing bell today. You're not even going to wait to see what happens. Bryn, why are you getting out?
Yeah, well, so I mentioned this on Monday. I've been in this stock for a minute, probably a quarter and a half. And I feel like when the market goes up, it doesn't go up. When the market goes down, it goes down slightly. I feel they're going to have very solid
Still in this box area that I said earlier. Still in the no trade area for me. Remaining patient. That which is understood. That which is understood need not be explained. I removed pre-market. Now we have yesterday's chart to go along with today's action. It's probably going to be a no trade day for me today. I'm in a call. Team, I am in a call. Alrighty, we rocking this call. Shout out to the team, those of you who are still in here with me, who waited for this, who waited for this. It's still not over, but you understand. It's still not over, but you understand why this area is a very solid trading area. 683.8 is the new target. 683.8 is the new target. Once we hit, if we get above 683.8, more bears will start covering. And that should take us right to a very smooth 685. Thank you guys for tuning in. Thank you for hitting the like button. Thank you for being patient on this journey. Patience is trading. Patience is a very key part of trading. So I've done my job. Now I'm going to let the stock do its job. Quiet soul, yes sir. Big Ben saying that 1 minute is brutal. Yeah, Ben, that's why it's best for us to refer to the higher time frames. I'm gonna be patient here. I know what's at stake. I know how important this area is. I see the structure that has already been established. Now let's let the market do what it needs to do. My job was to identify the trading area. My job was to wait until we got into that trading area, to look for a setup in that trading area, and then to take that trade. Now this yes sir. Quiet soul, so he's definitely not messing with it. Yes sir, I respect that, sir. This hangman does have me just a little concerned. But the fact that we're staying above that 683.3 area, which is a monthly area of support. That purple line is a monthly area of support. The fact that that monthly area is being respected, I see us potentially using that as a base to officially put the squeeze on every single pre-market bear, as we are now right back to the area of this morning's drop. It'll be very interesting to see what happens here. But again, I am still trading according to my rules. I came into today wanting a 681 call, getting in at 683, taking it to the 685.5, and then possibly the 687. I also like the 683 area for a longer trade, for a weekly trade as well. 683 entry. I believe we can take that all the way to 687, possibly even 689 for the week. So again, whether it works or not, we'll find out. But I definitely have a plan. And currently I am trading that plan. This is going to be critical right here. Critical area right here. Critical. We got a hangman and a shooting star. Yeah, the Bears are really trying aggressively right now to do the exact same thing they did yesterday in this area, that they did pre-market in this area. If they're successful again today, they'll come down. If not, the squeeze and the cover will commence. Looking forward to that if we get above 683.8. We'll be patient until it happens. I'm gonna go ahead and slide the arrow over just so that the trade doesn't get lost. I love it. It's just time and patience. All right, team. That's all I got. Chat is open. Just time and patience. I've done my job on this. Gonna let it do what it needs to do to put me in the money. So, just feel good about this position. Feel good about this area. I know this is an uncomfortable area for bears. And I'm glad that I've gotten in now while the market is just a little quiet. If we get above 683.8, you will see what I'm referencing to.